You're watching Chairman's Briefing, and I'm Rachel Lee. This episode is brought to you by TAG Oil. Let's get started. Ray Dalio, a legendary investor, has hopped onto X to warn his followers that current market chaos is just the beginning of something far more devastating. Quote, the far more important thing to keep in mind is that we're seeing a classic breakdown of the major monetary, political, and geopolitical orders. Dalio says that 5 existential threats are now converging. A debt-riddled monetary system on the brink of failure, fracturing democracies that are under extreme inequality, America's global dominance crumbling before our eyes, escalating natural disasters, and technological disruption that's rewriting all rules. He insists that these 5 forces and their interrelationships are the real drivers of overall big cycle changes. And he's dismissing tariff escalations as merely surface symptoms of deeper rot within global systems. While avoiding specific predictions about what's ahead, Dalio has previously and consistently said that gold is positioned to thrive amid the coming chaos. This past Tuesday, Trump ordered an investigation into imposing tariffs on critical minerals under Section 232, an American law that allows trade restrictions to protect national security. Now, this targets minerals like cobalt and rare earths after China, who is the world's leading producer, recently restricted exports. The move aims to reduce U.S. vulnerability and expedite domestic mining development. Now, on the heels of this news, gold climbed above $3,300 per ounce and remains heavily supported by a broadly weaker dollar, uncertainty around tariff announcements, and fears about a global recession. According to Luke Minotunga, who's a senior research analyst at FXTM, quote, beyond 3,300, it's all about psychological levels for gold prices. However, a bout of profit-taking or positive U.S.-China trade developments could trigger a sell-off. Goldman Sachs has upgraded its forecast 3 times already this year, projecting $4,000 per ounce by mid-2026. A recent Bank of America survey found that 42% of fund managers now expect gold to outperform all other asset classes in 2025. Volatility that gripped global markets over the past 2 weeks may be subsiding, but Trump's aggressive tariff agenda has damaged the dollar's status as a go-to currency. Evidence of this shift appears in broken market correlations since Trump's Liberation Day tariff announcement on April 2nd. According to Steve Englander at Standard Chartered, the market clearly has doubts now. While investors traditionally flee to currencies during market stress, the behavior has changed dramatically. The Japanese yen, Swiss franc, and euro have strengthened, while the dollar index has sunk to its lowest level in 3 years. Unlike previous dollar crises that eventually resolved, Macquarie Group strategist Thierry Wisman believes that this situation feels different. Quote, the U.S. is no longer the underwriter of its own system. Instead, the U.S. is going about disassembling that system in a non-diplomatic and abrupt way. Now, though any shift from dollar dominance will not happen overnight, the greenback has already fallen more than 9% from its January high. Although still below its 2011 peak, gold producers have surged in recent sessions, with the GDX mining index breaking through decade-long resistance levels. Daniel Oliver of Miracan Research offers perspective on gold's value. Quote, at $3,200 per ounce, gold represents 12.4% of the Federal Reserve's assets, which is below the 12.9% reading from 1971 when gold traded at just $37.40 per ounce. It remains cheap in U.S. terms. Oliver notes that global institutions are increasingly viewing gold as one of few assets capable of absorbing safe haven flows, while providing diversification from treasury bonds, aka IOUs from the government, to investors who purchase them. The junior exploration sector is generally long dogged by disappointment, but finally shows signs of life. While the broader TSX Venture Index remains below multi-year highs, The S&P/TSX Venture Gold Index has broken out of a decade-long base pattern. Oil remains one of the most reliable and indispensable energy sources in the world. It powers economies, enables industry, and drives daily life forward. It's also a foundational fuel essential to making the global shift toward a lower carbon future possible. TAG Oil is strategically positioned in this sector, advancing its Egyptian assets with an estimated 530 million barrels of oil in place. Led by Executive Chairman ABX.TO, whose regional track record speaks for itself, TAG Oil is unlocking overlooked resources with horizontal drilling. A recent independent reserves evaluation suggests that the Abu Rosh F target in Bed 1 alone could hold over 500 million barrels of oil in place. Now learn more at TAGOil.com. Just when resolution seemed near for Barrick Gold's Loulo-Gounkoto complex in Mali, the Malian authorities have shut down the company's office over alleged tax non-payment. Now, this West African operation produced nearly 700,000 ounces of gold in 2023 and represented 14% of Barrick's total output. Barrick has also invested over $10 billion in the project, which contributes up to 10% of Mali's annual GDP. In a rather concerning development for investors, Barrick has begun transferring key staff to their Kibali mine in the DRC, perhaps signaling that operations may remain suspended indefinitely. Alcoa is America's largest aluminum producer, and they disclosed a $20 million hit from Trump's 25% metal import tariffs. These costs stem from aluminum imports from Canada, where the company produces the largest chunk of its aluminum. This revelation marks one of the first concrete examples of American companies that are suffering from the administration's trade policies. Despite massive U.S. operations, Alcoa depends on Canadian production to meet customer demand. Alcoa's CEO had previously warned investors that these tariffs would put approximately 100,000 American jobs at risk, a prediction that's gaining credibility with piling financial losses. Ascot Resources is targeting August for their return to production at the Premier Gold Project in British Columbia. Thanks to over 61 million Canadian dollars in financing, the miner will address critical power capacity issues by ordering a new transformer that allows multiple equipment pieces to operate simultaneously. Premier was once North America's largest gold mine, producing 2 million ounces between 1918 and 1952. Ascot briefly achieved production last April before having to suspend operations after just 5 months due to insufficient underground development. The company plans to restart the mill in August at 1,250 tons per day initially, gradually increasing to full 2,500 ton capacity by 2026. Despite the positive development, shares fell 5.3% following this announcement. And that's your briefing for this week. If you're not subscribed yet or are new to the channel, please subscribe before you go. I'm Rachel Lee, and we'll see you next week.